Hello everyone and welcome to the Forxeduline channel. You're in the right place to expand your knowledge of the financial markets and improve your technical analysis skills. Today we're going to look at another important topic from the markets. If you are ready, let's jump right in. Today we will talk about the double bottom pattern, one of the most popular formations in technical analysis. This pattern appears at the end of a downtrend, a bear market, and gives traders strong signals that a new uptrend, a bull market, is about to start. In the video, we'll go through the structure of this key pattern, its formation stages, and trading examples step by step on real charts. First and foremost, you should know that the information contained in this video is not investment advice and is for general informational purposes only. Remember, Forex, crypto, and other financial markets always involve risk, and you must pay attention to risk management in your trades. When trading Forex, being able to anticipate price movement in advance is one of the core skills every trader aims to develop. Understanding what the market might do next helps you enter trades at the right moment and manage risk more effectively. That's why traders rely on various methods of analysis. While there are different approaches, such as fundamental analysis, technical analysis, and sentiment-based analysis, one of the strongest tools at the heart of technical analysis is price action. A key component of price action is chart patterns. These patterns form when price follows a recognizable structure, and they offer traders valuable insights into potential future movements. Chart patterns are generally divided into three main categories: continuation patterns, reversal patterns, and neutral patterns. The pattern we'll focus on today, the double bottom, belongs to the reversal patterns category. It is a powerful technical signal that often appears near the end of a downtrend, indicating that the market may be preparing to shift direction. So if you are ready, let's dive into the details of this important pattern. At first, the market is controlled by the bears, and prices continue to fall. Eventually, a moment comes when the bears start losing strength. So how do we notice this? The answer is simple. As prices drop, they meet a support level, and the decline stops. This is the first sign that the downtrend is beginning to weaken. Prices are unable to break below this support line, and a pullback occurs. This is where the bulls step in and start pushing the price upward. However, nothing is fully confirmed yet. At this stage, the first low of the double bottom pattern, called the first bottom, is formed. As you can see in the example image, the first bottom represents the lowest point of the downtrend and also the starting point of the upcoming upward move. After this upward move, the price reaches a resistance level and the rally pauses. This means the sellers attempt to regain control one more time, signaling to the buyers that they are not giving up easily. Then the price begins to fall again. However, it is unable to break below the previous support level. This tells us that the bulls have not given up. They are still fighting. The selling pressure from the bears becomes weaker compared to the buying pressure. From this same support level, the price starts rising once more, meaning the buyers win the battle. The sellers, on the other hand, lose momentum. As shown in the image, the price moves back and forth between support and resistance, forming what we call the double bottom pattern. As a result, the second low of the pattern, the second bottom, is created. The second bottom forms at the same level as the first bottom because both occur on the same support line. This is exactly where the pattern gets its name. On the price chart, we clearly see a structure with two bottoms. Now let's take a look at the most important part of the double bottom pattern, the neckline. In a double bottom formation, after the price forms two separate lows at nearly the same level, the highest peak reached between these two lows becomes the neckline. This line represents the resistance level that must be broken for the pattern to be confirmed. The importance of the neckline comes from the fact that it acts as a confirmation level. After forming the two bottoms, the price begins to rise. When it breaks above the neckline with strong momentum and volume, it gives one of the clearest technical signals that the bearish trend has ended and a new bullish trend is beginning. Another structural element we use when trading based on the double bottom pattern is the height of the pattern, shown as H. The pattern height represents the vertical distance between the lowest point of the double bottom, the dip level, and the neckline. This distance reflects the depth of the formation and, in a sense, the amount of energy accumulated in the market. The pattern height is used to determine the minimum expected target once the price breaks above the neckline. In other words, the most common target setting method in a double bottom pattern is to add the height of the formation to the breakout point of the neckline. This implies that after the pattern is completed, the price is expected to rise by at least the distance represented by H. This target reflects the minimum upward projection a trader may anticipate. When the price breaks above the neckline, it confirms that the bear trend has ended and a new bullish trend has begun. The quality of this breakout and the price action that follows play a key role in shaping the trading strategy. A strong breakout is the ideal scenario, where the price moves through the neckline decisively and with momentum. This signals strong buying interest and high confidence in the trend reversal. The price usually breaks the neckline with long, solid bullish candles with short wicks. After the breakout, it either does not retest the neckline at all or only touches it briefly before continuing upward with strength. Sometimes after breaking the neckline, the price pulls back to retest this level, which has now turned from resistance into support. This retest is common and provides an additional opportunity for traders who prefer lower risk entries. In short, the price breaks above the neckline, makes a small upward move, and then returns to retest the breakout level before continuing higher. Friends, now let's examine the double bottom pattern using real chart examples. On the chart you are looking at, the key elements of trading based on this pattern are displayed. The target level, calculated according to the pattern height measured from the price movement, is clearly marked. Additionally, the placement of the stop-loss order, the most important part of risk management, which indicates the point where the pattern would be considered invalid, is also shown. This visual helps to clearly illustrate both the expected reward and the risk that needs to be managed. In this trading example based on the double bottom formation, you see the strong breakout of the neckline, the most critical event that triggers the buy signal, has occurred. A strong breakout is an ideal scenario where the price decisively and quickly crosses the neckline upwards. This situation indicates significant demand in the market and shows that the trend reversal is sitting on a solid foundation. The breakout usually happens with long-bodied bullish candles, which confirms that the price has not only experienced a momentary rise, but has also completed that period with a strong close above the neckline. Such a decisive rise often creates the expectation of rapid progress toward the calculated target without a pullback, offering the trader an opportunity for a quick profit. The second chart example displayed on the screen now vividly illustrates the pullback, which often occurs after a breakout of the neckline. As you can see, immediately after breaking through this line, which previously acted as resistance, the price made a short correction and came back to test the same level again. This move is known in technical analysis as a retest, confirming that the previously broken resistance has now become a strong support. This confirmation process reinforces that the pattern has been successfully completed. For traders who prioritize risk management, waiting for the price to bounce from this new support level provides a safer entry point into the market. This scenario can also offer a better entry price compared to entering immediately after a decisive breakout. The successful completion of the neckline breakout process indicates that the price is now fully ready for an upward movement. Indeed, in this chart example you see, it is clear that the price, leveraging the momentum gained from the breakout, made a decisive jump upwards, initiating a strong bullish trend. This movement is the expected outcome of the double bottom formation and marks the beginning of the price continuing its rally toward the targeted level. This chart example you see is clear evidence that the double bottom pattern belongs to the most important category in technical analysis, reversal patterns. By the nature of the formation, we observe that it emerges at the end of a bearish trend on a price chart and, upon successful completion, reverses the previous downtrend. Consequently, with the breakout of the formation's neckline, the market direction has completely shifted, leading to the initiation of a bullish trend. This situation concretely demonstrates the formation's strength and its ability to terminate the existing trend. Guys, if you enjoyed this video about the double bottom pattern and want to see more technical analysis content, please make sure to like the video and subscribe to our channel. See you in the next tutorial, and take care.